Welcome to the Deep Dive, where we take a stack of sources, articles, research, our own notes, and basically extract the most important nuggets of knowledge or insight for you.
Think of it as your shortcut.
Exactly, your shortcut to being well-informed, maybe with some surprising facts, hopefully enough, interests to keep you hooked. Today, we're diving into the Forex market, specifically looking at the top economic events impacting global currencies. This is for the week of July 14th to July 20th, 2025.
Yeah, cutting through the noise.
That's the mission. Cut through the noise, reveal maybe some surprising things, and help you understand what's really driving market movements this week.
And there's a lot potentially driving them.
We've got some incredibly impactful data coming up, including what our sources are calling, well, arguably the most critical release of the whole week for the US dollar.
Definitely.
And there's some really fascinating nuances in the source material about how these events could trigger, unexpected shifts. It looks like a very dynamic week.
It really does. I mean, this week is packed with potential volatility, especially when you factor in the current geopolitical landscape and the different policy stances of the major central banks.
Right.
Understanding these key data points, it isn't just for currency traders, It's really about grasping the underlying health and direction of global economies.
And what that means for everyone.
Exactly. For investors, for consumers, everyone.
Okay, let's unpack this then. Starting with what our sources clearly highlight as the biggest event on the radar, the U.S. Consumer Price Index, the CPI data for June, due July 15th, 12.30 UTC, Coordinated Universal Time. So it's a measure of inflation, we know that, but what makes this report so pivotal right now?
Well, it's the primary measure, right? What consumers are actually paying. And it directly feeds into the Federal Reserve's thinking on monetary policy, especially interest rates.
Okay.
The market is, let's say, on high alert, waiting to see if this data confirms or maybe pushes back against these strong expectations for Fed rate cuts later this year.
Right.
And what's really fascinating here, according to our sources, is this idea that the inflationary kick from the Trump administration's tariffs, well, it hasn't fully shown up in the hard data yet.
Ah, interesting.
Yeah, so that creates a significant upside risk. Like, inflation could be higher than the current consensus forecasts are expecting.
Okay, so if the report comes in hotter, higher inflation than expected, what's the immediate impact? What are the ripples?
A hotter report could definitely delay or at least limit those rate cuts people are banking on. And that would significantly strengthen the U.S. dollar.
How much?
Well, for instance, our sources suggest if core CPI, that's stripping out food and energy, the volatile stuff.
Right, the underlying trend.
Exactly. If that shows a month-over-month increase of, say, 0.4% instead of the expected 0.3%, that could push Fed rate cut expectations back, maybe from September to November or even December.
Wow.
And that widens the short-term yield differential in favor of the dollar against, say, the euro or the yen. You could see U.S. two-year Treasury yields jump maybe 7 to 10 basis points.
Okay, and here's something I found really intriguing in the sources. This mention of traders holding record net short positions in the U.S. dollar,
Yeah.
that's basically a massive bet against it, right? It shows this widespread belief the Fed's going to cut rates. But what happens if they're wrong? What's the surprise scenario?
That's the kicker. If we get a hawkish surprise from the CPI, meaning it signals higher rates or rates staying higher for longer, you could trigger a massive short squeeze.
Explain that quickly.
It's where all those traders betting against the dollar are suddenly forced to buy it back to cut their losses, which of course just fuels the dollar's rally even more, amplifies the move upwards.
Okay.
Our sources also flag a big stagflation concern. If core CPI is too hot, the market might read that as stagflation, high inflation, and stagnant growth.
A nasty combination.
The worst. And that could lead to an even more hawkish Fed, which would pressure risk asset stocks, riskier currencies, and send money flying into safe havens, like the USD, maybe the Japanese yen.
And punish others.
Yeah, punishing higher beta currencies. Think the Aussie dollar, the New Zealand dollar. The probability of a volatility breakout for pairs like EURUSD, USD-JPY, it's estimated over 75% in that hot scenario.
So, a lot hinges on this one number. What's the strategy mentioned?
Suggestion is breakout trading, basically setting orders to trade if the price breaks through key levels. Specific ideas were buy stop orders on USD-JPY around a 157.55 and sell stop orders on EURUSD near 1.0720, trying to catch that potential hot inflation move.
Okay. So, while the US CPI is huge, global sentiment is also watching the East, right? Let's pivot to China. Q2 GDP and June activity data. Also July 15th, but earlier, 02.00 UTC. What's this data set telling
Yeah,
us?
this is really the most comprehensive look we get at China's economy this quarter.
Yeah.
A real holistic view. It directly impacts global risk appetite, commodity demand.
And currencies linked to that.
Exactly, like the Australian dollar. Our sources are generally expecting a bit of moderation after a strong Q1.
Now, the sources mention this as a potential double-edged sword for Europe and the euro. Can you unpack that? It sounds counterintuitive.
It is a bit counterintuitive. Normally, strong China data is risk on,
Hmm.
right? Good for global growth, good for cyclical currencies like the euro.
Yeah.
But in the current climate, with all these trade tensions, if Chinese manufacturing or export data comes in too strong, the US and EU might see that as evidence of, overcapacity or dumping.
The political angle.
Precisely. And that geopolitical reaction could actually worsen market sentiment, especially for trade-reliant economies like Germany. So it could pressure the euro even if the initial reaction to the data itself is positive.
Tricky. So how do you trade that uncertainty?
The recommendation from our sources is to look at options, specifically maybe straddle on AUSD.
Remind us what a straddle is.
Sure, it's where you buy both a call option and a put option with the same strike price and expiry. You're basically betting on a big move, but you don't necessarily care which direction, up or down, as long as it moves enough.
Got it. Okay, sticking with inflation, but heading back across the Atlantic. UK CPI for June, that's out July 16th, 06.00 UTC. How critical is this one for the Bank of England, the BOE?
Very critical. The BOE is sort of gradually easing policy, but they're still pretty cautious, especially about sticky service sector inflation.
Right.
Our sources point out that if that service CPI number comes in hot, it could force the market to basically price out one of the two rate cuts expected from the BOE later this year.
And the impact on the pound?
That would likely cause UK government bond yields, gilts, to surge, and it would boost the pound's carry appeal significantly against the euro and the US dollar.
Carry appeal meaning?
Just the attractiveness of holding a currency because its interest rate is higher than another currency's rate.
Right.
You profit from the difference.
Okay. But you mentioned a distinction, maybe a short-term boost versus a longer trend. Are there factors limiting how long the pound might rally, even with hot data?
Yeah, that's a really key takeaway from the sources. While a hot report could definitely boost GBP short-term, the BOE's overall policy direction, the bigger picture, is still towards easing.
So the underlying current is pulling it down.
Sort of, yeah. That underlying trend makes it tough for a rally to really last. So any surge in the pound because of this CPI might actually be seen by some traders as a chance to sell at higher prices, especially against the euro, given the relatively weaker Eurozone economy.
Interesting. So the strategy suggestion reflects that.
It does. It suggests mean revert trading on URGBP. That means betting that the price will eventually snap back towards its average. So maybe looking for opportunities to buy URGBP if it drops sharply, say towards the 0.8450 support level on that potentially hawkish UK data.
Okay, after those big inflation numbers, we get a look at the U.S. consumer. Retail sales for June, out July 17th, 12.30 UTC. Why is this one particularly important this month?
Well, consumer spending is huge, right? Roughly two-thirds of U.S. economic activity. And the May data, that showed the biggest drop in 4 months.
Yeah, I remember that. Partly tariff worries.
Partly, yeah. Consumers seem to pull back a bit ahead of those tariff threats. So the market's now really looking for a recovery in June, some sign of consumer resilience.
How do we read this one alongside the U.S. CPI we talked about earlier? They seem like they could paint very different pictures of the economy.
You absolutely hit the nail on the head there. You have to read them together. If CPI is hot, but retail sales are weak, that really strengthens that tricky stagflation narrative.
Right. Bad for the Fed, bad for markets.
Exactly. Very complex environment. If both are strong, rate cut expectations get pushed out further, dollar probably rallies.
If both are weak,
Then the dollar likely faces selling pressure. Fed might feel more inclined to cut sooner.
so what's the strategy recommendation for retail sales?
It's a sell the fact suggestion, meaning if the data recovers like expected, the dollar might pop higher initially, but maybe that rally isn't sustainable because of deeper concerns about consumer debt. So traders might look to sell after the expected good news is already out.
Okay, shifting gears a bit. Away from specific data points, we've got the G20 meeting. Finance ministers, central bank governors, July 14th to 18th in South Africa. Our sources say the main risk here isn't policy decisions, but unexpected statements. Why is the unpredictability the main thing?
That really is the core issue. The biggest risk isn't some pre-announced policy shift. It's more like a diplomatic incident Or maybe a joint communique statement at the end that's surprisingly tough or divisive.
Because markets expect.
Markets usually expect these things to end with fairly general, non-committal statements, pleasantries designed not to rock the boat.
So a surprise would be.
A surprise would be something like a strong, unified statement pushing back hard against U.S. tariff policies. Or, conversely, a very public disagreement or rift between major members. That kind of thing would be a major surprise and could really shift market sentiment for days, creating unexpected volatility.
How do you prepare for that kind of risk?
The recommendation is basically geopolitical risk hedging. If you have significant exposure, consider maybe buying short-term put options on stock indexes that protects you if markets fall, or buying traditional safe haven currency pairs like USD/JPY or maybe Swiss francs CHF/JPY.
Got it. Okay, let's head down under Australia. Employment change for June, out July 17th, 01.30 UTC. Why is this jobs report so critical for the Reserve Bank of Australia, the RBA, especially after they held rates recently?
Well, the RBA did surprise markets a bit by holding rates. They said they wanted more evidence that inflation was sustainably heading back to their target range.
Okay.
So a weakening labor market now. That would significantly dial up the probability of an August rate cut, and that would put downward pressure on the Aussie dollar.
And Governor Bullock's comments.
Yeah, our sources highlighted that RBA Governor Bullock kind of indicated their rate hold was more about the timing of cuts, not necessarily the direction.
So a weak jobs report could signal that the timing is now or very soon.
Precisely. On the flip side, if the report is strong, it suggests the RBA was right to be patient, maybe pushes rate cut expectations back a bit, and that would likely give the Aussie dollar a strong boost.
Strategy for the Aussie jobs data.
If the data comes out weak, the suggestion is trend following. So if unemployment ticks up, or job growth disappoints or goes negative, look for chances to sell IUD/USD as the price potentially breaks below key technical support levels. Basically, ride the downward trend.
Makes sense. Okay, another CPI report. Canada's this time. June data.
Yeah.
Released July 15th, 12.3 UTC. That's the exact same time as the U.S. CPI.
Yep, double header.
What's the key tension for the Bank of Canada, the BOC here?
Well, the BOC has also held rates, largely citing uncertainty around U.S. trade policy, but their recent inflation data has shown some persistent core pressures, even while their labor market has been surprisingly strong.
So a bit of a tug of war for them, too.
Definitely. A real tug of war between that hot labor market and maybe some signs inflation could be easing, plus the big shadow of potential U.S. tariffs hanging over the economy.
How did the sources see the BOC navigating that, especially with tariffs being a downside risk?
The sources suggest it makes the BOC's reaction pretty unpredictable.
Right.
But given that tariff threat is a clear downside risk for Canada, they might be more sensitive to any signs of inflation cooling down.
So a weak Canadian CPI might be welcome news for them.
Could be the perfect excuse, yeah. A weak report would give the BOC a clear reason to adopt a more dovish tone. Maybe signal rate cuts are coming.
And the strategy, especially given it releases alongside U.S. CPI.
The recommendation is to consider buying USD CAD if Canadian inflation comes in weak, especially if the U.S. CPI released simultaneously is hot. That divergence in data and likely policy would really favor USD CAD going higher.
Right, policy divergence is key. Okay, beyond the live data releases, we also get the minutes from the Fed's June meeting. FOMC minutes, July 16th, 18.00 UTC. Chair Powell already spoke after the meeting, so what extra insight can we get from these?
These minutes give you a much more granular look, deep insight into the actual discussions among the committee members. There are different views on inflation, growth, the path forward for policy.
So even after Powell's press conference, there's still value here. Where should people focus their attention in the text? What are the subtle things to look for?
Absolutely. The value is finding those nuances maybe glossed over in the presser. Crucially, pay attention to any discussion about the threshold for starting rate cuts, what conditions need to be met, and also the level of consensus or disagreement within the committee.
And if that threshold seems higher than expected.
Any indication that the bar for cutting rates is higher than the market currently thinks, that would be a hawkish signal. Could definitely move markets. The suggested approach here is tone analysis. Really read between the lines, look for subtle shifts in language towards hawkish or dovish, and use that to confirm the existing trend for the U.S. dollar.
Okay. Also, on July 16th, 12.3 UTC this time, we get the U.S. Producer Price Index, PPI, for June. How does this fit into the inflation picture alongside CPI?
PPI measures inflation earlier in the pipeline, right, at the wholesale level. What producers are paying for inputs. It's often seen as kind of an early indicator for future consumer inflation. for CPI.
So more of a confirming signal then, rather than a primary driver itself. What kind of confirmation are we looking for?
That's a really good way to put it. Our sources basically say PPI's main job this week is to either confirm or maybe contradict the signal from CPI.
How so?
Well, if both CPI and PPI come in hot, that strongly reinforces the case for a hawkish Fed. But if CPI is hot and PPI is weak, that might suggest the price pressures aren't maybe as widespread through the whole economy, maybe more temporary, could ease some of the Fed's concerns, potentially.
So strategy-wise for PPI.
Use it mainly as a confirmation tool. It's generally not recommended, based on our sources, to open a brand new trade based only on the PPI release. Look at it in context with CPI.
Got it. Okay, finally, something a bit different. Throughout the whole week, we need to keep an eye on policy signals from the State Bank of Vietnam, the SBV. No fixed meeting, but what actions or statements should we be watching for?
Yeah, any actions or statements from the SBV can definitely have a significant impact on the USD-VND exchange rate, the dong. Our sources note some recent senior appointments there, and this emphasis on flexible credit management. It suggests maybe a reinforced operational setup at the central bank.
And what's their main challenge right now? Our sources mentioned a strengthening global dollar and domestic inflation pressures. June CPI up 0.48% month on month.
It's a really difficult balancing act for them. They've got strong economic growth. H1 2025 GDP was up 7.52%, which is huge. But they also need to stabilize the exchange rate to control imported inflation, especially with the dollar being strong globally.
How are they handling that?
Recent statements seem to prioritize macroeconomic stability. That suggests they're trying to manage both growth and inflation, trying to keep the currency from getting too volatile.
So what should traders watch for specifically?
The strategy suggested is to closely monitor the interbank market movements, that's where banks lend to each other, and the daily central exchange rate fixings. Any clear signs that the SBV is actively selling foreign currency reserves? That would be a strong signal they're committed to stabilizing USD-VND near current levels.
And that
could create opportunities to sell rallies in USD-VND, betting that the central bank intervention will cap the upside.
Okay, wow. That's a lot to cover. So looking across all these events, from the huge US CPI to the G20 chatter to Vietnam, what currency pair do our sources suggest has the most potential for a big move this week? And which one carries the most risk for, our listeners to be cautious about?
Okay, based on our analysis, USD-JPY seems to be the pair with the most potential for movement. It's right at the crossroads of the two big drivers this week, which are Fed policy, which hinges heavily on that US CPI number, and just overall global risk sentiment. A hot US CPI could easily send USD-JPY pushing through key resistance levels. Especially, remember, with that market positioning, we talk about the potential for a big short squeeze.
Okay, so USD-JPY for potential. What about the high-risk one?
On the other hand, AUD-USD looks like it carries significant risk. It's really exposed on multiple fronts.
How so?
You've got critical data coming from both China and Australia hitting it.
Right.
Plus, it's very sensitive to those global risk sentiment shifts that could come from the U.S. data or any G20 surprises. Volatility for the Aussie dollar is expected to be pretty large and potentially quite unpredictable. A real high-wire act this week.
Okay. And wrapping it all up, what's the sort of overarching strategy recommendation that ties these insights together for the week?
I'd say the key theme is prioritizing breakout trading strategies around those crucial U.S. and U.K. inflation reports. Our sources also strongly recommend considering options for events with more binary outcomes, like that China data release. Gives you flexibility.
And the G20.
Yeah, and given the G20 meeting and that potential for geopolitical surprises, just maintaining caution, being ready to hedge against unexpected risks seems really crucial for protecting your positions this week.
Fantastic. Thank you for guiding us through what looks like a really detailed and, frankly, quite impactful week. You've really shed light on how interconnected all these global events are.
Oh, it's always a pleasure to dive into these dynamics. It's fascinating stuff connecting all the dots.
Thinking about this week's analysis, it really highlights something, doesn't it? How just one data point, like that US CPI number, it doesn't just affect the dollar. It can send ripples, actual waves, through the entire global economy.
Absolutely. Influencing central banks everywhere, trade policies.
Even geopolitical sentiment, like you said with the China data, it just makes you think, in a world that's so interconnected, how much more vital is it for all of us to understand not just what's happening, but the why and the how these seemingly separate pieces all fit together.
That's a great point. Definitely something to ponder.
Something to ponder as you navigate the coming week. That's all for this deep dive. We really hope this has given you that shortcut to being well-informed, maybe sparked a few aha moments, and giving you a clearer picture of what lies ahead.
Hope so.
Until next time, keep learning, keep questioning, and keep digging deeper.